In this video, I'm going to try to teach you how to make millions using the simple trading strategy. You don't need any indicator, you don't need anything. Just by watching these candlesticks, I'm just going to show you how to make money. Okay, so what you just need is this thing. You open your trading if you're a trader. Okay, so I'm going to be talking to people that already know something about trading. If you're a new beginner, this might work for you, but some things might just not, you might not recognize them for the first time you hear them. But if you have been in the trading industry for a while, well, you understand a lot of things. So now, what am I talking about? I want to show you a simple method, a very simple method. Like, it's an open, high, low, and close trading method. But I'm going to show you in the most simplest way that you think it can be this easy to make money. But the truth is it is that easy. And I'm going to show you in this video. So if you open your weekly time frame, you're going to need three time frames, 3 to 2 time frames, a lower time frame and a higher time frame. Start from the weekly or the monthly, depending on how long you would like to hold onto your trades. So I'm usually trading intraday, right? And trading here and there, getting in and out. So what you need is the weekly time frame. I'm sorry I didn't script this video, so you're going to hear a lot of arms and all that. I didn't need to script this video. I just went freelancing, and I want to show you something wonderful, something beautiful. Nobody is going to show you this on the internet. Something this simple to use to make money. Okay, to use to make money. So if you open your weekly time frame like this, what you're going to do is to mark the previous week's low, the low of the previous week's candle. Mark it like that, and then mark also the high. Mark the high of the previous weekly candle like that, and like that. And then also mark the closing, and then take a vertical line and mark where you're going to be trading the next week, the coming week. Mark where you're going to start trading with a vertical line. This is going to be like a roadmap. It's going to help you know what you're going to be doing on the lower time frame, that you're going to get your entry, right? So if you see the higher time frame, it doesn't make tops and bottoms a lot. Like, the higher time frame can move a lot going one direction. That's the reason why we are using the weekly time frame to do this. So now right here, why were we doing this? We're doing this so that we know whether we're going to be buying or we're going to be selling. If the higher time frame is buying, then if we're going to the lower time frame, we're going to filter all the sales that we see, and we're going to wait for the buys. That is important. This is the reason why we are marking that. So the opening price, you can mark it when the market opens on the week that you are trading, okay? But also mark it if you're going down on the lower time frames. It's also very, very important. So after that, you're going to go to your daily time frame, and when you come here, and this is Monday, this candlestick, it's Monday, right? Most of the time, maybe it's going to be a down close candle. If Monday is a down close candle, then there is no trade. This method is best if Monday is if Monday is a down close candle, we are going to wait for an up close candle to confirm that the market is ready to start going up. I don't know if you understand that. We're going to wait for an up close candle for the market to confirm that the market is going to go up, because there's no way you can know that the market is going to go up. You don't want to go and catch falling knives, okay? Don't try to pick tops and bottoms. That will really hurt you if you are trading. That will really hurt you, right? So as you can see, Monday was an up close candle. That means we've got our trade entry signal. This is our trade entry signal. So what do we know from right here? From our higher time frame, weekly time frame, we know that the market is not going to go lower than 28.54. That's the low of the previous week's candle. And then the market is going to open around 28.82. This is the previous week's closing price, and it opened around 28.86, up around 82 to 86. That's not a lot of points, so that's why it opened. It kept a little bit higher, and then it opened, and then started rallying higher. So what you want to do is to wait for an up close candle, and then you buy. You want to buy following the higher time frame. You don't want to be opposing the lower time frame. If your trades are following the higher time frame, trust me, you're going to have trades that go to the take profit and won't really bother you a lot. They won't bother you a lot, and you're going to enjoy trading. But if you oppose the higher time frame, you're really going to have a bad time trading. You're going to hate trading, trust me. But if you follow the higher time frame, you're going to enjoy trading, because trades are just going to explode to the direction of the higher time frame. That is very important. So how do we enter after we have seen our trade entry that we've got an up close candle? We enter on the opening price of the next candle after the up close candle. I don't know if that makes sense to you. We enter on the opening price of the next candle. So now that will be this. That means we'll be buying here, right? And then where do we put our stop loss? We put our stop loss right there on that low, because you know that the market isn't supposed to go where, isn't supposed to go there if it's going to go up. That's what we know. And then we can take our profit. It depends on where you want to take your profit. You can aim for 1:1, 1:2, 1:3. But if there is a high that is high there up there, especially if we have had a huge retracement on the last week, I like to aim for that high. Okay, I like to aim for that high. Doesn't mean that you go there, but most of the time it does, because it has to form a new higher high. I hope you understand this concept. So right there, as you can see, you buy there and then you go and sell there, and then you take your profit and go home. So if you still want to reduce this to another lower time frame, you can use this Fibonacci. I've got the settings of the Fibonacci in my channel, so right there, as you can see. And then you're buying on the opening, and then you think the stop is too huge, just use this and put your stop loss right there, and there's the high. See, and then you risk a lot more less money, and then there's a 1:2, I don't know 1:2 what, but that's you'd have risked less money and more profit. So if you think the daily time frame is still too huge for you, you can continue going to the H1 time frame, and here you go. On the H1 time frame, I like using the period separators for my daily candles, right? I like using the period separators for my daily candles. So right here, as you can see, Monday we opened up, rallied up, and then consolidated a little bit with this consolidation right there. And then Tuesday, that's when we were looking for a buy, because Monday was an up closed and the weekly time frame is going higher, and we're looking for a buy. So you could have just bought. There's no need to buy the low. Just buy when you see this candlestick right there. Put your stop loss right here, and then you take profit right there. As you can see, on Monday the take profit wouldn't have gotten hidden, but you would have closed it around 3,000 in profit, right? So you would have closed around 3,000 in profit. If you do not understand what I'm talking about, because I didn't script this video, you can watch it again and again and again and again, and then it will start to click in your mind what I'm trying to show you. Then you can go to your charts and do the same as I am showing you right here. It's just a simple trading method. It doesn't need a lot of moving parts. It's a simple model. Anyone can use it. You don't need any indicator. Just this. That's all you need. So if you keep on looking right here, I wanted to show you, for those that like staying, if you wanted to buy, and this is more of for advanced traders really, it's not for newbies. If you look there, we have what ICT traders call as the fair value gap, which is a gap which is below the 50% of the Fibonacci, right, retracement level. And see that gray area, you could have bought right there and waited for the market to go higher. Why would you buy there? Because you believe that the market is going to go way up using the weekly direction. So thank you for watching, and I hope you understood what I am trying to show you. Good luck and good trading.